HSA contributions reduce a person's ACA-specific modified adjusted gross income, which can affect whether the person qualifies for marketplace subsidies. This will be particularly important for people to understand, starting with the 2026 plan year, as the, quote, subsidy cliff will return in 2026 unless Congress acts to extend the subsidy enhancements that are scheduled to sunset at the end of 2025. My commentary here, again, this is the reason the government shutdown is happening right now. This is the issue that the Democrats have picked to fight over. They want those subsidies reinstated. Quoting again, so a person who is facing the loss of all subsidies in 2026 might find that by contributing to an HSA, they can bring their modified adjusted gross income into the subsidy eligible range. Welcome to the Sunlight Tax Podcast. In this show, we're talking about taxes, money, and careers for self-employed people who have a big vision for changing the world with their work. I'm your host, Hannah Cole, artist, tax pro, author of Taxes for Humans, and the founder of Sunlight Tax. If you're a creative or wellness-oriented entrepreneur who wants to grow your business sustainably, manage your taxes, and build a stash of fuck you money so you can control your time and have a bigger impact with your work, you are in the right place. Hello. As you know, I have been bringing you a series on the One Big Beautiful Bill Act, the tax law that was passed on July 4th over the summer. And it is a massive piece of legislation. It's a really important piece of legislation. It's going to affect everybody. It's going to dramatically balloon our deficit and restrict future discretionary spending of the government in the next 10 years because of the degree to which it expands the deficit. What it's going to mean is that the U.S. will be forced to pay so much money in interest and servicing the debt that it will crowd out funding on basic social safety net items, which, in my opinion, is a deliberate part of this legislation. So I want to bring you some information about the healthcare provisions in the One Big Beautiful Bill Act. And in part, I'm going to quote from a wonderful article written by author Louise Norris. I am excerpting this article with permission, and I will link to the full article in the show notes. So definitely take a look at this article. It's really wonderful. The author is Louise Norris. This was originally published on healthinsurance.org, and the title is One Big Beautiful Bill Act Brings Sweeping Changes to Health Coverage. All right. So I'm going to kind of read, summarize, talk about this article. And in part, what I want to do is really talk to you about the things that are going to affect you right away and next year, especially because at the time of recording, we are in a government shutdown. But because the Democrats are using the issue of healthcare and the Republicans cutting so many people out of healthcare, it's a good issue to dig in on right now since it is kind of the crux of why the government is shut down at this moment. Okay, so I want to talk about what is coming up and what's going to affect you personally. I will not read everything in this article. I'll summarize some parts, but please take a look at the full article. It's really good. Hey, real quick. I just want to pop in and tell you that my book, Taxes for Humans, is available for pre-order. When you pre-order, you get two massive bonuses. One is instant access to the first chapter, so you can be the first to dive in. The second free bonus is my money-saving on-demand class, IRS Proof Your Deductions, which normally sells for $97. Taxes for Humans is the funny, empowering, practical tax guide that will help you do your own taxes and make them easier every year. I took 2 years to make it a great, useful tax guide, the most useful you've ever seen, and your pre-order means the world to me. Go to sunlighttax.com/book to pre-order and get those bonuses. Again, that's sunlighttax.com/book. Okay, so one of the really important things to realize about the One Big Beautiful Bill Act, which I may call the B3 for ease, is that a lot of the health coverage effects are not actually going to take effect until 2027 or afterwards, okay? This is timed deliberately to not actually affect people until after the midterms. Legislation is often written this way so that taxpayers don't make a connection between where the political thing happened, where the legislation came from, right? So if you just voted in the midterms and there was a sweeping upset over the current Republican administration and Congress, and we voted in a bunch of Democrats, and right after that moment, all these healthcare cuts come into effect, many people are going to think, oh, well, the Democrats must have cut all this healthcare. Well, in fact, no, that is unlikely to be the case. But the way that the bill is timed, it is timed to hit people with those cuts right after, presumably, a Democratic sweep happens. So it's important just for your knowledge to understand that this kind of timing is a part of bill writing, and it's definitely a part of this bill. All right. So most of the health coverage that will be lost in the upcoming years are due to the Medicaid changes that will be implemented in 2027 and future years. So just to let you know, those are the biggest impacts, and they won't come right away. Now I'm quoting from the article for a minute. This is in addition to the millions of people who are expected to lose health coverage due to the anticipated sunsetting of the marketplace subsidy enhancements at the end of 2025 and the new marketplace rules that were finalized in 2025. Altogether, the number of uninsured people in the U.S. is expected to increase by about 17 million people in the next decade or so, due to the One Big Beautiful Bill, the expiration of the subsidy enhancements, and the new marketplace rules. But some of these rules are going to take effect right away and in 2026, so those are the ones that I want to bring you, and those are the ones that this article concerns itself with. Now, just so that you understand, the sunsetting of the marketplace subsidy enhancements, that is the issue at the core of the shutdown right now, and so this is highly relevant information. So I am going to read you that part of the article. All right. So reading to you from the first part of the article, Medicaid applications and renewal will get more complex. All right. Quoting now. In a nutshell, Medicaid enrollees will face more administrative hurdles when applying for or renewing coverage. Who's affected? Medicaid and CHIP enrollees, including those in Medicare savings programs, MSPs, and especially older adults and people with disabilities. So let me read a little bit about what's going on with the Medicaid cuts. So for some background, and I'm quoting, in 2023 and 2024, the Biden administration finalized a two-part rule designed to simplify and streamline the application and renewal process for Medicaid, including Medicare savings programs, which help to pay Medicare premiums and out-of-pocket costs for beneficiaries with low incomes and asset levels. The Children's Health Insurance Program, CHIP, and basic health programs. The Biden administration's rule included provisions such as eliminating in-person eligibility interviews for people with disabilities and those 65 or older, changes to ensure that fewer people would lose coverage due to undeliverable mail, and a ban on lockout periods for children disenrolled from CHIP for failure to pay premiums. Starting immediately, H.R. 1, the One Big Beautiful Bill Act, prohibits the Department of Health and Human Services from implementing, administering, or enforcing that rule, at least through September 2034. As is the case for other Medicaid cuts in the One Big Beautiful Bill, sources project these changes will lead to a decrease in federal Medicaid spending due to fewer people being enrolled in the program. So here is what people affected by the change can do. In order to enroll in and renew coverage, people may find that they may need to complete additional paperwork or comply with other new rules. If you're enrolled in Medicaid, including an MSP or CHIP, it's essential to make sure that the state Medicaid agency has your correct contact information and that you quickly respond to any administrative requests related to your eligibility or coverage renewal. Okay? All right. So a second effect of the bill that goes into effect right away is effects on Planned Parenthood, which actually administers most of its healthcare is not abortion related. So just to understand, this is a healthcare cut that has nothing to do with abortion, but it's still a target. All right. So in a nutshell, I'm quoting here. A B3 provision eliminated Medicaid reimbursement for the costs of any health care provided at Planned Parenthood or other, quote, essential community providers, unquote, that offer abortion care. Who would be affected? Planned Parenthood clinics and similar, quote, essential community providers and Medicaid enrollees who receive any type of health care at these clinics. This takes effect starting immediately on the passage of the bill. But it has been temporarily blocked by a court ruling. So understand that this is a place of controversy. There is a court injunction at the moment, but let me read you a little bit more into this section of the article to just help you understand what happened. All right, so as soon as it was enacted, the OBBBA was to have eliminated Medicaid funding for 1 year for entities that are, quote, primarily engaged in family planning services, reproductive health, and related medical care, unquote, and that provide abortion services in situations other than rape, incest, or a danger to the mother's life. It's important to note that longstanding federal rules already prevent federal funding from being used to pay for abortion care, except when the abortions stem from rape, incest, or a danger to the mother's life. Thus, non-accepted abortions, dubbed non-HIDE abortions, cannot be funded with federal money. So the change under the OBBBA results in federal Medicaid funding being cut for non-abortion care, such as cancer screenings and contraception. This resulted in some Planned Parenthood clinics notifying patients that they could no longer accept Medicaid. So just to kind of catch you up to speed here, Planned Parenthood filed a lawsuit to block this immediately, and the judge issued an injunction. So this is in the courts now. All right, another effect. Low-income immigrants will lose subsidy eligibility. So in a nutshell, recently arrived low-income immigrants will no longer qualify for subsidies to buy marketplace health insurance. Who's affected? Lawfully present immigrants in their first 5 years in the U.S. with household incomes below the federal poverty level. Okay, this takes effect January 1st, 2026. I'm going to let you read the link to the full article to get the details on this provision, but I want to make you aware that that is part of the pretty quick effects of this bill. Okay, now one that I want to really dig into for you, especially because if you listen to the Sunlight Tax podcast, you likely have self-employment income. And this particular change in the bill is part of what the shutdown is over right now. It is about these sunsetting subsidies for health insurance coverage. And a lot of people, because open enrollment begins in November, a lot of people right now are about to see their premiums skyrocket. It will be a shock, okay? And the Democrats know this, and they have shut down the government over this potential advanced premium tax credit premium shock because the subsidies, if they are allowed to run out as they are scheduled to at the end of 2025, everybody's health, if you have marketplace coverage, your coverage premiums are about to go through the roof. Okay, so let's dig into the details here. I am quoting from Louise's article now. Quote, in a nutshell, starting with 2026 coverage, so just sidebar, and that's the coverage that you're choosing now during open enrollment. So starting November 1st, very, very soon. In a nutshell, starting with 2026 coverage, there's no limit on how much excess advanced premium tax credit a marketplace enrollee might have to repay if their income ends up higher than expected. Who's affected? Marketplace enrollees who receive advanced premium tax credits, especially those with income fluctuations. Ding, 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 self-employed people, that's us. This takes effect on your 2026 tax filings based on your 2026 coverage, okay? So you will feel this happen to you in 2027 when you file your taxes for 2026, okay? So it's going to be a minute until you feel the effects, but I'm telling you now, in 2027, when you file your tax return, that excess advanced premium tax credit that you had been getting, you are going to have to repay it, potentially, with no limit, okay? So listen up. Again, I'm quoting here from the article. So most marketplace enrollees, 92% in 2025, qualify for advanced premium tax credits. APTC is based on an applicant's projected income for the relevant calendar year. The federal government advances the estimated premium tax credit on the applicant's behalf to their health insurer throughout the year. But the following year, the advanced premium tax credit has to be reconciled when the enrollee files their tax return for the year. If the income an enrollee earns during the year doesn't match what they projected when they enrolled, the IRS might owe them additional premium tax credit, or the enrollee might have to pay back some of the excess advanced premium tax credit that was paid on their behalf. That right there is the subsidy, okay? Until now, there has been a cap on how much excess advanced premium tax credit people have to repay, as long as their household income was less than 400% of the federal poverty level. The specific amounts were indexed each year by the IRS, but the most a person would have to repay in excess APTC for 2024 was $3,150 if their household income was as high as 399% of the federal poverty level. But the One Big Beautiful Bill Act eliminates those caps. Starting with the 2026 plan year, if your income ends up being higher than you projected, there will no longer be a limit on how much excess advanced premium tax credit you have to repay. Instead, you will have to repay all of the excess regardless of how much that is. What people affected by the change can do. When people enroll in Marketplace coverage for 2026, it will be essential to project income as accurately as possible. The Marketplace will ask for proof of income if the projection you provide doesn't match what the information the Marketplace gets from data sources like the IRS. It will also be a good idea to double-check your income projection midway through 2026 to see if you're on track to earn roughly the amount you projected when you enrolled. If not, you can update your income in your Marketplace account, and they'll adjust your subsidy in real time. This could help to avoid having to repay excess advanced premium tax credit when you file your 2026 tax return, which will be particularly important once there's no longer a cap on how much excess advanced premium tax credit has to be repaid. Okay. And last but not least, I want to talk about how more Marketplace plans can be used with health savings accounts, HSAs. Okay. So this is from the author, Louise. In a nutshell, millions more people with high deductible Marketplace plans will become eligible to contribute to health savings accounts. Who's affected? Marketplace enrollees with bronze or catastrophic plans and consumers using direct primary care. This takes effect in January 2026, okay? So let's talk about the changes to HSAs. Starting with the 2026 plan year, Marketplace enrollees with bronze or catastrophic plans will be eligible to contribute to a health savings account. Through the end of 2025, HSA contributions can only be made by someone who has an HSA-qualified high-deductible health plan, as defined by the IRS. But starting with the 2026 plan year, so the one that you're planning for right now, the HDHP definition will expand to include all Marketplace bronze and catastrophic plans. Before 2026, most bronze plans are not high-deductible health plans, since most bronze plans do not meet the current IRS high-deductible health plan requirements. And then just to let you know that on top of that new revised definition of a high-deductible health plan, which enables you to contribute to an HSA, a health savings account, the One Big Beautiful Bill relaxes the rules around HSAs and direct primary care arrangements. So starting in January 2026, having a direct primary care membership in addition to a high-deductible health plan will no longer disqualify someone from contributing to an HSA. In addition, the DPC, direct primary care membership fee, will be considered a qualified medical expense, meaning it can be paid with pre-tax HSA funds. This is really great news. I don't know about where you are living, but here in Asheville, there are actually a couple of really wonderful direct primary care arrangements, which I think is an interesting solution to the healthcare crisis. I have friends who use, for example, Lantern Health here in Asheville and love it because the lab fees are so low. You know, they get a lot of access. It's really cool. So I like this provision. All right. So one last detail about HSAs and why they matter so much. in a world where your income determines the subsidy you get on your premiums, let's dig in to what Louise Norris wrote here about why HSA access matters. Quote, contributions to an HSA are pre-tax. Investment gains or interest earned in the account are also not taxed, and HSA withdrawals are not taxed as long as the money is used for a qualified medical expense. In other words, they're a great deal. They're a fantastic savings and investment vehicle. All right, that's my commentary, not hers. Quote, in addition, HSA contributions reduce a person's ACA-specific modified adjusted gross income, which can affect whether the person qualifies for marketplace subsidies. This will be particularly important for people to understand, starting with the 2026 plan year, as the, quote, subsidy cliff will return in 2026 unless Congress acts to extend the subsidy enhancements that are scheduled to sunset at the end of 2025. My commentary here, again, this is the reason the government shutdown is happening right now. This is the issue that the Democrats have picked to fight over. They want those subsidies reinstated. Quoting again, so a person who is facing the loss of all subsidies in 2026 might find that by contributing to an HSA, they can bring their modified adjusted gross income into the subsidy-eligible range. Marketplace enrollees should discuss this issue with a financial planner or accountant before selecting a plan for 2026. If contributing to an HSA makes financial sense for them, it will be important to select a high-deductible health plan during the open enrollment period, which is now, keeping in mind that bronze and catastrophic plans will be considered high-deductible health plans as of 2026. So I hope that helps you understand better a little bit of what is going on in the provisions in the OBBBA. Thank you so much to Louise Norris for giving me permission to excerpt this article. Please check out the article in full. It's really wonderful. I will link to it in the show notes. All right. Thanks for listening. I will see you next week. Bye. Thank you for listening. If you like the show, please be sure to subscribe, leave a review, and share it with a friend. It really helps. I'm so grateful. My tax guide, Taxes for Humans, is available for pre-order at sunlighttax.com/book. This podcast is for education and entertainment only. Nothing in this episode should be taken as individual tax or financial advice. You can find all the tools, books, and links I reference at sunlighttax.com/podcast.